Hello everyone, and welcome to your Glassnode video report for week 42. I'm your host Checkmate, and we're recording this on the 18th of October 2021. So this week we've rallied up to about $62,000, sitting just a couple of $1,000s underneath the all-time high. So truly quite remarkable price performance. Bitcoin's performing extremely strong over the last couple of weeks. And really what we're looking at as we get closer to the all-time high is how are the long-term holders in particular, those that hold the most amount of coin, what are they exactly doing on chain? Are they spending? Are they hodling? What is their behavior? Because typically we see it start to transition as prices approach the previous all-time high. So what we're going to look at is the long-term holders, their spending patterns, what's it looking like in terms of the supply dynamics. We'll look at the amount of profits and losses that are being realized on chain. And then we're going to close out by looking at the derivatives market, where we've seen some fairly explosive growth in the options market and in the futures market. We're seeing open interest climbing and leverage starting to creep back into the system, and what that may mean in terms of potential headwinds moving forward. So let's jump into the analysis and we'll start running through our dashboard. So as I mentioned in the intro, we've seen a number of particularly strong weeks in terms of price performance of late. We really rallied out of this very, very low consolidation down here at 29,000. We saw a very, very strong August, a pullback in September down to 40,000, and then we've pushed back up to within a few $1,000s of the all-time high. So truly quite spectacular price performance from Bitcoin. Ethereum is also trading almost at its all-time high. So we are seeing this growing sentiment, that we are pushing the prices higher. And the market is obviously getting increasingly bullish as things start to rise. Now, on that note, when we look at our UTXO realized price distribution, so remember what this is telling us is what is the price at which the circulating supply last moved on chain. And what we can see is we've really fleshed out and built out this very, very strong, a series of nodes of support all the way up. These are zones where buyers stepped in and believed that there was a value out of that position. You can see here's our $30,000 cluster, which we had during January, and then again through the May through to July period. And then as prices have traded higher, it's really filled in this block. And this is really showing us that there's a very, very large amount of volume sitting underneath the current price. Now, on the flip side of that, there's about 1.66% of the total supply at the time of writing the report. You can see it's actually less. We were sitting on this bar previously. So there's even less volume that was last moved at higher prices at the moment. So really, the people who have held their coins since essentially the all-time high back in April, they have weathered all of the ups and downs and volatility of the last 6 months. So the probability that they're going to sell and just get their money back is relatively low. Most people would have just capitulated at the bottom. So there's a fairly good chance that the coins that are above us are essentially those who've weathered the volatility, and they're probably sitting there waiting for higher prices. So where will the sell side come from? Primarily, it's going to come from our long-term holders, and that's essentially all the people who accumulated in the previous market cycles, and also essentially from around May period is where we've got that long-term holder 5-month threshold. So really, we're talking about people who are distributing their coins to a higher level as being the dominant side of that sell. Now, we can actually see in our long-term holder net position change that we've had a number of very, very strong months. So whenever this metric is in the green, it means that more coins are crossing the short to long-term holder threshold than the other way around. We saw distribution during the first phase of the bull market, which is fairly typical behavior. And what I would suggest for recommended reading, there's a link in the show notes that essentially shows us there's an article that we put out the other week that shows how these long-term holder spending behaviors typically switch over as we break previous all-time highs. So note that long-term holder spending started to increase as we broke through the $20,000 all-time high of last cycle. So as the bull market wore on, long-term holders spent more and more of their coins, and it's really only been since we had the sell-off down here in May through July that we saw this fairly substantial increase in long-term holders. So many of those coins started being reaccumulated, and there was a new value add position. Now note that during the current week, we've seen a fairly significant softening in our long-term holder net position change. Now it's still green, so there's still coins migrating across that long-term holder boundary, but it's certainly at a lesser rate. Now there's two different realities as to why that would be softening. The first one is the most obvious one, which is that long-term holders are spending their coins. So there's always some magnitude of coins transitioning across the boundary, and when they're being spent, it's essentially offsetting that. So you're getting fewer coins, even though there's still a net overall transition of coins into long-term holder status. And the other side is that 5 months ago, there was a period of just smaller accumulation, and therefore there's just less coins overall crossing that boundary. So we have two concepts here, and they're probably both in play. There's some area that's going to have less accumulation that happened 5 months ago, and there's another take, which is that there's long-term holders spending. So what we're now going to look at is the realized cap HODL waves and the binary coin days destroyed to try and answer this question. So what we can see here, the standard HODL waves looks at the total circulating supply and it categorizes it out by age brackets. You can think about looking at the age demographics of all of the coins on a BTC basis. Now, conversely, the realized cap HODL waves introduces the concept of price into that model. So rather than looking at the BTC volume, where you'll see in the standard HODL waves Satoshi's coins, which are more than 10 years old, there's a fairly substantial amount of those coins that are reflected in the standard HODL waves. However, if we look at the realized cap HODL waves, 10 years ago, Bitcoin had a very low or no price for those Satoshi coins, and you can see that it represents almost no total volume. You can't even see the purples and the dark blues in this chart. So what this one is mapping out is at all of the prices when coins last moved, what is the age demographics of them? So what we generally see in the warmer colors down the bottom here, these are our 24-hour, 1 day, 1 week old coins. When we see an expansion or a growth in these younger coins in terms of coin value, that means that older coins are being spent to create that influx of new coins at higher prices. So it's showing that that lifespan was destroyed, long-term holders spent their coins, and you can see that we had this same impact during the early phase of this bull market. We saw more of these old coins being spent and therefore a growth in the number of young coins. And this is essentially what we're seeing here in this long-term holder net position change. Long-term holders spent their coins and they went from old to young. Now, since February, we've seen this fairly structural downtrend, which started to bottom out and plateau all the way through our May, July, August, and September period. It was fairly flat, and this reduction in young coins is telling us the opposite effect, where we're actually seeing more hodling, more accumulation, less older coins being spent, and we can see that there's this baseline pattern here, which is essentially looking like our 2019-2020 accumulation period. So this is how we can start to tell that there was accumulation going on during this last couple of months. And then what we're seeing this week is an uptick in the number of coins that are represented in these younger coin bands. We're seeing a slight uptick. It's not significant, but it is present. It's observable in the on-chain data, which again aligns with what we're seeing in our long-term holder net position change. And also note that we've had a few upticks of our binary coin days destroyed metric. So binary coin days destroyed, well, every time that the amount of coin days or the amount of lifespan, a year-old coin has 365 days worth of lifespan, whereas a 1-day-old coin only has 1 coin day. When that year-old coin is spent, it's destroying a lot more coin days. Now, what binary coin days destroyed is looks at the long-term average. What's an average amount of coin days destroyed on a particular day? And did this day destroy more or less than that long-term average? Is it above or below average, what we normally see? And we will see these uptrends. Note that during the first phase of this bull, at the same time that we had long-term holder net position change increasing, more old coins being spent, we had an increase in our binary coin days destroyed. More than average lifespan was destroyed each day. We can then see the slowdown of spending through into the April high, which we also see more of these gaps start to open up. As we move into the May to July correction, we see a significant reduction. These gaps really open up. This is what accumulation looks like, where you have far fewer coin days destroyed. That means that old coins are dormant, more likely to be accumulating. Old coins are dormant, more likely to be accumulating. And you can see that these generally line up with periods of long-term holder increasing rather than decreasing. So what we can really take away from this whole message is that it is likely that we're seeing these long-term holders spending some of their coins. That is okay. That's very normal. It's what we typically see as prices rally up to all-time highs. And normally it occurs at an accelerating rate. You can see this in our long-term holder position change, where you've got this increasing rate of spending as price rallies higher and higher. So the other way to think about this is that long-term holders are selling, but the market price continues to rally, which is actually telling us something about the demand. There's enough demand to currently absorb those supply, and we're still holding prices over here about $62,000. So it's telling us a little bit about that supply and demand balance. Where are the coins coming from? And is there enough demand to actually come in and soak them up? So to really categorize what we're talking about when we talk about the amount of demand, or how much coin needs to be sold and how much demand needs to come in to buy it, to essentially put some kind of a top in. Is there a risk that maybe this is actually some kind of double top, or is the demand currently enough to actually potentially push us through to new all-time highs? So what we're looking at here is the realized profit. So this is the amount of coin value that's been realized as profits and spent into the market. And likewise, coins that were last moved at a higher price, how much of that is realized losses, both of them in US dollar denomination. And we're looking at a 90-day median. So this is the very, very long-term view. Now, what you can see is that during the rally in H1 2021, realized profits peaked to very, very high levels. Note that the amount of profits that were being realized was up here above about $1.78 billion per day on a 90-day basis. And you can see that it peaked at the same time that prices peaked. This is showing that the market was trying to absorb $1.7 billion a day in profits, but eventually the market couldn't, and we had this correction to the downside. Now, as prices fell, long-term holders spent fewer and fewer and fewer coins. They didn't believe that it was worth spending their profitable coins down here at 30,000. And note that this actually bottomed more or less at the exact bottom of the recent correction. Now, what we've seen is a plateauing through August and September and slightly picking up, particularly in the last couple of weeks. So at the moment, profits being realized is around $644 million a day. And remember that this reflects, as the prices continue to rise, it's showing that the market is currently able to absorb those profits. So it's telling us a little bit that there is enough demand to continue pushing the market higher. Now, if we flip over to the realized loss chart, where we previously had our realized profits peaking at the peak of the market, note how our realized losses peak at the exact bottom of the market. What we're seeing here are people who accumulated their coins in the topping zone capitulating at the absolute bottom. So it's actually telling us the complete opposite story. We're seeing the smarter money distributing into market strength and eventually putting the top in by realizing profits. And then people who are accumulating those coins spend them at a loss after a 50-60% correction. So it's this very interesting dynamic that we can actually see play out in terms of the market dynamics, the supply side, the demand side, and which entities are actually stepping in to accumulate those coins, and when do they then spend them at a later date. So it's just interesting to see the total magnitude of profit and loss that's realized and the particular points in time when that's occurring. So if we then look at things like our realized profits to value ratio, so our realized cap it's kind of the on-chain equivalent to the market cap. The realized cap looks at every coin in the circulating supply and says at what price did it last move, and that's its realized value. And if you think about it, if you withdrew a coin back at $10,000, you have saved that amount of value in Bitcoin. And until you spend it again, well, we generally assume that that's a selling transaction. Until you spend it again, at very least, we consider that to be the on-chain cost basis. It's the cost of acquisition, or at least the last time that psychologically every holder interacted with their coins. So what we do is we take a ratio between the amount of realized profits, so this green line, and our realized cap. And what this is trying to do is basically showing how much profit is being realized relative to the market size. So you're comparing on a relative basis when a huge amount of profits being realized relative to market size, and when are they not? When is it relatively insignificant? And we've got this green and red zone, so you can see that down in 2020, back when we had our March 2020 crash, we essentially had a very, very low realized profits to value ratio. Very low profits were being realized, and relative to the market cap, it was essentially saying that the market could absorb that sell side, and it was more likely actually a bullish scenario. It was an accumulation phase. Now, as we started realizing more and more and more profits on the rally higher, note that this ratio started to climb. It's saying that the market is spending more, realizing more profits than the realized cap is growing. So it's showing that the market size is smaller relative to the amount of sell side action. And this ultimately in February actually peaked. We saw it peak a few more times through to April and then into May, and then we had our significant correction and decline, and it almost fell back down into the green zone, not quite, but close. And where we're sitting at the moment is it's somewhere in this middle ground. So it's kind of saying that it's not insignificant sell side, but it's also not significant relative to market size. We're not at any kind of extreme at this point in time. And more or less until there's any other information to tell us otherwise, it's likely that the market is in a fairly sustainable position at this point in time. So it's kind of telling us a coincidence story with our price where it's holding 62,000. We can see there is some profits being taken, but clearly the market is able to absorb that. So it's telling us a little bit about a equilibrium type state, which is relatively positive overall. We can also then look at this. This is our last metric in terms of the on-chain space. We're kind of going to distill all of that previous information, which is that we know long-term holders are selling. We know that that's okay, and that's very, very normal for this point in the cycle. As prices reach all-time highs, this is typically what happens. And we're also seeing that there is enough demand to continue to push and sustain higher prices. So it's kind of telling us this equilibrium is in play. And the exchange net position change is actually telling us a very similar story. We saw inflows through the May to July period. Then we saw the market revert to significant outflows, more or less completely undoing all of the inflows and some. So we've taken more coins out than flowed in. And note that over the last couple of weeks, essentially since the September lows, we've seen a softening of the exchange net position change, and it's actually returned to a relatively neutral level. So what neutral means is that over the last 30 days or the last month, we've essentially, the inflows have matched the outflows. Everything is in equilibrium. So again, it's kind of painting this similar picture. Now, obviously, that's not as bullish or constructive as if we had sustained outflows. Obviously, outflows are showing more demand than supply. But bear in mind that there is the same amount of demand, or demand is meeting supply at a time when more coins are being spent and sold. So it's showing that there's an increase in the amount of supply, but the demand is still sufficient to essentially keep it at neutral. Now, what's going to be interesting to pay attention to is whether we do get more sustained inflows. What does that tell us? Are we seeing that we're actually getting an oversupply, and maybe that would push more towards a corrective type behavior? Or if we actually sustain at pretty much at all-time highs and we've still got equilibrium, it's also not the most bearish thing in the world. So it's this kind of interesting equilibrium at the moment. And quite frankly, when we look across the transaction space, the transaction volume space, it's still very quiet. Most people who are in this market are those longer-term holders and people who understand and have experience within this market. We haven't seen that influx of all the news and the media and the rising transaction values. It's still relatively quiet despite being a few $1,000s off all-time highs. So at a very interesting level, we're at equilibrium up here, which is truly quite remarkable. So what we're going to close on is looking at the derivatives space. Now, in the short term, derivatives can certainly create some kind of volatility. In this instance, what we're looking at is how leveraged long is the market, because we're obviously seeing positive price action. Generally, people go leverage long during those positive periods. And unfortunately, people can often go a little bit too hard, and sometimes that can end up in a cascading long liquidation. It can also happen in a short liquidation. So when too many people are leaning on the wrong side of the boat, the market tends to push in the other direction and create this momentum. And in this instance, what we're looking for is there a risk that we have a downside pullback? So in the option space, we've seen open interest climb. This is quite remarkable, actually, up to about 12.7 billion. It's about 107% growth since the September low. So a huge amount of options volume is increasing. We can see our volume up here about $1.5 billion in a day. And you can see that this spike correlates with pretty much the all-time highs from the previous period of time. So there's a huge amount of influx of options trading. Bear in mind that options are still relatively small relative to the overall market structure. If we look at our perpetual futures volume, we're talking 50, 25, 75 billion, and at the moment we're talking 1.5 billion for options. So quite a bit smaller, about an order of magnitude smaller in size. But nevertheless, when we actually look into which direction these options are, by and large, they're actually call options, and the bulls are essentially buying $100,000, $150,000 call options for the end of the year and onwards. So overall, it's telling us that there is a general leveraged long side to this. There are traders who are essentially betting that we're going much higher over the next 3 to 6 months, and that's where the dominant volume has been coming off from in these options trades. Now, similarly with our perpetual futures markets, we are not at all-time highs, but we are certainly not too far away from it. So we're seeing more and more people taking on leverage, placing their bets. We can also see that the funding rate for perpetual markets is positive. So it's showing that there is a bias to the long side. So we have near all-time high open interest. We have overall positive sentiment. Note that it's not exceedingly high. It's nothing like what we saw back here in early 2021. But again, it doesn't necessarily have to be. It's actually quite similar to what we saw before the sell-off in September. So there's not actually an absolute value for what funding rate is too high. There's no actual, once it reaches this value, it's too much. What you have to look at is across the board, do we have a lot of metrics telling a similar story? And here we have rising open interest, more contracts are open, positive sentiment across the board. Our options are screaming higher, mostly driven by bulls buying call options. And simultaneously in our perpetual markets, note how the volume is actually declining. Over a larger period of time, the volume is actually relatively down. So if we were to get some kind of liquidation cascade or some kind of sell-off that triggers many of these contracts getting liquidated, there may not be as much volume to try and support and catch that market. Normally you want high volumes to essentially have traders to be taking both sides of the equation. Here we may not actually have that in play. So it's not necessarily a guarantee that there's a risk, but it's something that you can start factoring in when we look across all of these metrics and we summarize everything we've looked at today. We've got long-term holders that are spending, which is normal, but is creating overhead resistance. We've got leverage in our options and our futures markets. And by and large, they are relatively long. So people are bullish at all-time highs. And within all of that, everything is kind of in equilibrium, which is still painting a more bullish than a bearish picture, but it does suggest that maybe there's some shorter-term headwinds that may or may not happen, but it's just important to be factoring all of this into your risk models and just understanding what are all the potential outcomes and trying to assign probabilities to each one. So hopefully that was useful. As always, please give us a rate, review, and subscribe, and get your comments in there to let me know, what you're enjoying, what you're learning about with these metrics. Is it helping stitch all these different pictures together? And I will see you in next week's video. Cheers.